Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500 and we're going to be asking a very important question today. Is an economic slowdown, so a contraction in company earnings, about to drive the next leg down in the market? This is an incredibly popular narrative out there. We've seen a huge number of people talk about this. Now, the first part of the correction on the S&P 500 would be driven by a contraction in valuation, so PE ratios moving down, as you can see on this chart. But the second part of this correction being driven by earnings contracting. So PE ratios are a price that investors are willing to pay for a specific amount of company earnings. So you can see that's what this blue line represents. It's the valuations of the S&P 500, how much investors are willing to pay for how much the companies are making. But if all of a sudden you have a big recession, a big slowdown, and earnings begin to contract in a big way, then you can actually have the same PE ratio, but still have stocks going down because earnings are contracting. All big market gurus out there on Twitter, on YouTube are talking about this, and this is really the big narrative behind the fact that we're in a bear market and that it's far from over. Now, as you guys know, we like to bring a different approach to the market and bring up ideas that not many people are thinking about. And we do tend to be very skeptical on ideas that a lot of people agree on and that are consensus, because that's usually the moment when you want to be going in the opposite direction. So let's answer that question in today's video. Should we expect a second phase of the bear market driven by decline in earnings, an unexpected contraction in earnings by the market? If you are interested in following these crazy markets with us, make sure to smash that subscribe button. Also, make sure to click on that like button if you enjoyed this episode. If you learned something new, if you find it helpful, don't forget to click on that like button. It really does push our videos out to a wider audience. Now, without further ado, let's get right into it. Now, the first chart that I want to show you guys is this one right here. And basically what we did on this chart is compare the correction on the S&P 500 against the corrections on earnings, right? Company earnings. And this chart really gives you a better visual aspect of what's going on and how this dynamic actually works. So you can see here the S&P 500 in black here. The market capitalization of the S&P 500 went down in the first half of 2022. We all know that. It's been just above a 20% correction, and it's been purely driven by valuation contraction. So as we've seen inflation rise, as we've seen yields rise, oil prices rise, investors have gotten concerned about the stock market. And as a result, we've seen PE ratios contract and lead the stock market. But it hasn't yet been driven by a contraction in earnings. You can see the red line here has not begun to come down. And you can see, for example, in 2008 and 2000, let's see what happened in those periods. The drawdowns in the stock market, so the black line, actually fell in line with the earnings. So earnings were coming down, the red line was coming down at the same time as the stock market was moving down. You can see that happen in 2000, and you can see that happen in 2008, where economic growth surprised to the downside. And so when earnings weakened significantly, you started to see the market fall in a significant way. But you can see you didn't have a valuation contraction before the market started to come down in a big way. In fact, it really is earnings that started to lead the S&P 500, and the S&P 500 fell as a result of earnings moving down, which is substantially different to what we're seeing now, where we've seen the S&P 500 move down in anticipation of earnings contracting. And so to understand exactly what is going on here, we went back to the high inflation episodes of the 1970s, where you actually find a much more similar dynamic to what's going on today than what was going on in 2000 to 2009. Let's take that 73 episode here, that 1973 episode, and you can see here the black line. So the stock market was moving down in anticipation of the earnings contraction that was to follow. Very similar to what we have today. Now, this was a much bigger bear market than what we've seen in 2022. But the point I'm trying to highlight here is look at what happened to the stock market when earnings began to contract. You can see right here, earnings started to contract and the stock market actually bottomed before earnings contracted. Now in 1969, you had a slightly different dynamic where earnings did trigger the next part of the leg down. So that's something to keep in mind. But in 1966, I believe, you had a similar type of correction to what we've had today, which is that you had the market move down as inflation was spiking. It moved down almost 20%. And by the time earnings started to contract, the market had already bottomed. And you can see we had a similar type of development in 1990. In 1989 here, the market actually moved down very far ahead of earnings. The market corrected almost 30% very rapidly here in 1989. And actually, by the time earnings started to contract and you actually felt the slowdown in economic growth, the market had already recovered back to its all-time high. So that's an extreme example. But the idea behind this is that in all of these episodes, the market was a lot more driven by what inflation was doing rather than what earnings were doing. And so basically the contraction in PE ratios in these instances was basically the market pricing in the earnings contraction that was to follow. And by the time the earnings contraction actually did follow, the market was already on its way higher because the Fed was pivoting and investors were able to price in the recovery after the contraction, right? In high inflation episodes, it seems like the market begins to look forward in advance very significantly because this is a predictable dynamic where you have lots of tightening and as a result, you get an economic slowdown. And investors can calculate that, they can predict it. And that's what happened in these episodes where you had inflation surge, monetary tightening surge, and so investors were able to price in the slowdown before the slowdown occurred. This is why this was happening, and this is why we believe it's happening today. And you can see in that example in 1989, where the stock market was actually led the recession multiple months in advance and was actually back to the all-time high by the time the earnings contraction started. Guess where the market bottomed? It bottomed right at the end of the inflation spike right here. So basically, as inflation was spiking and yields were rising here, the Federal Reserve was hawkish. So basically here, as inflation was spiking, investors were pricing in slower economic growth in the future. But once inflation subsided, once inflation came back down, oil prices started to drop, investors were able to price in stronger economic growth. And the same thing happened in all of these episodes. Right here in 1973, the market bottomed as inflation started to drop back down again. Even though between 1974 and 1976, earnings were weakening, earnings were contracting, and yet the market rallied an astounding 79% off its low, despite the fact that earnings were weakening here between 1974 and throughout 1975 and 1976. Right here, earnings were weak, and yet the market was rallying very impulsively off its low. By the way, if you're so far enjoying this episode, don't forget to leave us a like. If you appreciate the time and effort that goes into making these videos, it is really appreciated. It really does help push out our videos. And if you're new here and you're learning something new, if you're finding this useful, don't forget to smash that subscribe button. Now, another chart I wanted to show you guys was the changes in PE ratios when the SP 500 was moving down in these episodes, right? So in these high inflation episodes, what were the SP 500 drawdowns relative to the PE ratio drawdown? And you're going to quickly understand why this is extremely relevant. Now, first of all, you can see that we're more or less in the range, in the vicinity of the drawdown you can kind of expect in terms of the SP 500 move down and the PE ratio move down. This is what we've seen throughout past big inflationary episodes. The only big exception being 1973, where you had a massive almost 50% drawdown from the all-time high. Also, you can see that blue line here, the PE ratio change has exceeded the change in the SP 500. And so you can see here in 1973, that was the case, and in 1966, both of them being the episodes where the market bottomed before earnings began to contract, right here again in 1966. Now, of course, if we start to see earnings contract, you're going to see this black line become larger, but this is definitely an interesting chart to look at. Now, I do have one more very interesting chart to show you regarding earnings in high inflation episodes and what you can actually expect from earnings when inflation exceeds 5%. And this really changed the entire way we're looking at this. Before I do that, I do want to quickly talk to you about the trading room. If you want to interact with me, if you want to ask questions to the Game of Trades team, whether that's about our trading strategy, our investment strategy, the way we're currently seeing different parts of the market, portfolio allocations, or if you want to make chart requests where you ask for a ticker symbol and we give you a technical analysis on that ticker symbol. We are online on the trading room throughout the trading day. We've also significantly improved the quality of our responses and how quickly we respond to people. So if you are interested in having access to that type of service, make sure to click on the link down below. There are a limited number of spots on the trading room because we can't take care of everybody. So don't waste time and check out the service. Now, one more very interesting chart that helps give a broader picture of what's going on in the market is the impact of high inflation on earnings. Now, generally, earnings are driven by consumer spending, right? If consumer spending is going down, you're generally going to see a decline in earnings. A big exception to that was 2000 because of the tech bubble, and you had a lot of capital misallocation. So the earnings recession was not driven by consumer goods spending, but it was mainly driven by the tech bust. But in most other cases, a drawdown in consumer spending tends to lead earnings lower. So a lot of people today are talking about another 2008 financial crisis where real consumer spending that's dropping here is going to trigger another massive move down in earnings similar to 2008, 2009. But if we take a look at high inflation episodes and what happens to earnings when you have this type of drop in real consumer spending, it seems like a drop in real consumer spending has much less of a big impact on earnings. And you can see here in 1973, consumer spending dropped by 60%, and yet earnings only dropped by 10-15%. The same thing goes for 1981, where consumer spending dropped by 40%, but earnings only dropped by 20%. And the reason for that is because real consumer spending is real, so it's adjusted for inflation. Earnings per share are not calculated by inflation. So when you've had a surge in inflation, let's say 8.6% like today, that's actually a tailwind for earnings. And that's why we say that the stock market is a protection against inflation, because it is the case. Company earnings tend to go up with inflationary cycles. And that's why a drop in real consumer spending doesn't have that much of an impact on the actual underlying earnings, which is again a very different dynamic to what we had in 2008, where real consumer goods spending actually triggered a massive drop in earnings. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.